This is the Self Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Well, hello, everyone, and welcome back to the Self Storage Podcast. I am your host, Scott Meyers, and today I'm excited to introduce to you my good friend and partner, Pat Willson. Pat is a husband and father with a full-time career working for a global energy company, and on today's episode, he will be discussing the ins and outs of investing passively in self-storage. Pat lives in Texas with his wife and daughter, where he enjoys spending time with family, camping, hiking, and fishing, and it's by taking the passive investing route to self-storage that has provided him with a pathway to participate in the real estate sector without infringing on family and career responsibilities. So without further ado, I would like to welcome to the show, Pat Willson. Pat, how are you today?
Hi, I'm good, Scott. Thanks. It's great to connect with you again.
It is. And I'm glad that, I don't want to say glad that we got through the holidays, maybe glad that we got through 2020, but good to catch up again and to catch up with you to find out what's going on. So brief introduction, why don't you fill everybody else in on your path in real estate and self-storage and how you come to the place where you have been investing passively in self-storage versus the active route, at least at this time.
Sure. As you said, I've got a full-time career with a global energy company, and that's been quite demanding. This month will be 27 years with that company. So over the past couple of decades, I've enjoyed a fantastic career that I've really enjoyed. And over the course of that, I've earned and saved, and I've been looking for opportunities to invest my savings. The storage segment has been something that's always been quite appealing to me that I've wanted to learn more about. And actually, it's been about 4 years ago now when you first passed through my hometown here that we met, and I started to learn more about this asset class and the opportunities that were available. And the more I learned about it and the different pathways that were available for participation, the passive investment really resonated with me, considering what was going on with my career, the demands in that space, with what was going on in my family as well. So I've really enjoyed the journey and where I'm at in that space.
Well, Pat, obviously, we really enjoyed working with you. And yes, when we met 4 years ago, started down the path of, you would come to us to learn more about self-storage, done research on your own, and then began our mentoring program. And really just, that's when it took off. And, your approach to how you analyze the facilities and markets has been better than just about anybody that's come through our organization. And it seems like, and I don't want to put words in your mouth, but your background combined with your approach to how you look at facilities, really made you maybe second guess the facilities and the projects that you looked at, and then maybe how you arrived at going the passive route versus investing on your own. Is that fair to say?
Yeah, I mean, when I say we, I mean my wife and I, who has been a big help on this journey as well. She's an accountant and a CPA, and my education is an engineer. So we're both a bit analytical, and I would say our investing style is a bit conservative. So when these opportunities become available, we do a good bit of due diligence to satisfy ourselves before we take the leap and jump into a passive opportunity.
Mm-hmm. Well, one of the ways that, I think some of the folks that we talk to that are investing with us passively have realized they started the journey like yourself to go out and invest actively. And the more they dug in, they received the offering memorandum from the brokers and the figures and the financials from the sellers. And only to find out that, as they run through, done their own underwriting and research the market and set their projections, that, they weren't going to make as much as either the broker had projected or that the seller had stated with regards to the performance of the facility. And then as you begin to look at the marketplace, once you get to that place where you decide to pass on it, many folks found that in the marketplace that there were other folks that were really good, had a lot of deal flow, really good at underwriting and creating value. And the returns that they were offering to their passive investors to come along as partners were equal to, and in some cases a little bit higher than some of the projects that people were finding in their own backyard or in their own markets. And so therefore they thought, well, gosh, if I invest passively, I don't have to do all the heavy lifting Why would I when I can do it with somebody else who also takes on the liability of the loan and is responsible at the end of the day for the success of the project? So tell me how you came to, is that when you invested in your first project passively, was that the benefit of it, or was that just kind of the nature and the course that, your career took, that you ended up in a passive investment first before going off and looking to do something active?
Sure. You touched on a couple of points that really resonated with me when I started this journey. And one was the leverage that exists in this pathway. And when we think about leverage, leverage can mean lots of different things, right? Leverage can mean, leveraging financing from other parties, but from a passive investor perspective, by having the opportunity to invest passively, I find that I get to leverage the experience, of a promoter that's putting the deal together. I can leverage their experience, their network, their team, and what they're doing, as well as it allows me to participate in much larger projects that I probably could if I was out there trying to tackle something on my own as well. So I really like the leverage that I'm able to enjoy as a passive investor, participating, but also the diversification that it allows me, right? So again, rather than sinking my time, my energy, and all of my funds into a single project, I can look across a much broader landscape of asset classes that I might choose to participate in. I can look across different areas of the country that I probably wouldn't get to, or I don't have the
Mhm.
market intimacy to give me the confidence to pull the
Mhm.
trigger and invest.
Mhm.
But also across different time horizons, right? When we think
Mhm.
about, what's going on in the market cycles, and rather than having all my eggs in one basket on a single project. So I really like the leverage as well as the diversification that's
Mhm.
offered to me by investing passively.
Mhm. So Pat, where have you found and how do you go about searching for the passive opportunities versus actively looking for deals to invest in?
The more I look, the more I find there's a lot of people out there doing this type of thing, right? And some of the things that I spend most of my time on, I would say there's really three primary criteria that I dig into before I make commitments. And one is the sponsor, who's behind it. Another is the market that the deal's in, and then the deal or the project itself, and what that looks like. So I know that there's a lot of folks out there promoting opportunities, but I've found the ones where I've participated in have been, referrals, folks that you've introduced me to, where somebody I trust has introduced me to somebody else, and it's been through that kind of immediate network of mine rather than some random email that comes in.
Well, then let's touch on each one of those areas, and that is the order that I believe that a passive investor should be looking at is first of all the promoter itself, then looking at the market and whether those projections, the market will produce those projections for the project, and then obviously the project itself. So, what are some of the things that you're looking for, Pat, when selecting a promoter? When you see something and come across, or even a referral, how do you vet that promoter to make sure that they're the real deal?
Yes, certainly there's a lot of different attributes that I would like to see in a promoter, or that I'm looking for when I'm evaluating an opportunity. I mean, I want to partner with somebody that I know to be trustworthy, of good moral character and credibility, preferably somebody that I have a prior relationship with,
Mhm.
or knowledge. Somebody that's organized and can lead a team and make things happen. Somebody that's capable of delivering the results that are being promised in the pro forma.
Mhm. How do you vet that? How do you vet their performance and their experience? What's the best ways to research the history and the historical performance of a promoter or a company?
I mean, certainly I'm looking at the package and the marketing information that they have available, looking at, what information they can share on their experience, but
Hmm.
also looking for references. If I
Hmm.
don't know the individual, it's like, who can I speak to that has some experience participating in past projects? What's their experience been working with the individual as well?
Hmm. Yeah, and we find that to be key. Most of the folks that come to us have been referred to us, and we're very thankful for that because we do what we say and we produce what we had projected to produce for our folks. And at the end of the day, when I look at investments or relationships that we enter into, it's almost all referral based. There's just no substitute for that, period. So let's talk about the market now. Tell me what gets you fired up about a particular market that a facility may be located in.
Yeah. The market, I find secondary to the individual, and just following up on your last question about the sponsor and evaluating the sponsor, I often find beyond references that asking some questions of the opportunity of the market on what is it that drew the sponsor to this market, right? Why do they like this market? And I find that, that type of conversation with the sponsor tells me a lot about their personality or their style, their confidence or their intimacy and level of detail that's baked into the overall project. So, the projects that I participated in, Scott, are in parts of the country where I had no intentions of participating when I started on this journey, but they were things that came to me by individuals that I respected and trusted, and with each opportunity, we do a bit of our own due diligence, right? I would say a light market study to probe and dig beyond the information that the sponsor is sharing, just to trust but verify the information that's being provided, to satisfy myself on the population growth, the job growth, and what's going on in that specific market, to be confident that over the time horizon that's being discussed here, that's going to be a strong enough market to allow the project to be successful.
Well, it's one thing, as you said, even before you were going to say it, I was going to say trust but verify, and we're very thankful that our investors, that they don't ask a lot of questions of us, but by the same token, I'm a little taken aback when they don't perform their due diligence. Certainly they're here and they're on our webinars and they're investing with us for a reason. They found us, they referred to us, or they've been a past investor in one of our projects. But when it comes to the market and performance of the project, when we have a presentation by way of a webinar and or even the offering memorandum, a little bit surprised that we don't get questions with regards to some of the numbers, the projections, or just probing and digging a little bit deeper. As a matter of fact, I welcome that. And even in the beginning of this journey, several years ago, when we put together our first project, our first syndicated project, I was surprised that even on the passive side, that folks wouldn't hop on a plane or get in the car to come out and look at this investment, even if they were investing passively, that they were taking it at not necessarily face value, but based upon our projections and the feasibility study, and the myriad of data that we have behind it. But by the same token, still a little bit surprised that people didn't come out and actually visit and vet and do a little bit more research on the market and the project, as well as meet with myself. What would you say to that, Pat, and some of the folks that you invest with passively? What percentage of those folks take it to that next level and really dig in and vet the promoter and the project and the market?
Yeah, I would just say that I think there's probably a lot of different personalities and investing styles out there. I'm more of a conservative type, and I'm investing my hard-earned funds that really represent my retirement and my daughter's education, and I take these things quite seriously. So while we're talking about passive investing, I put a lot of time and effort into the evaluation of the opportunity on the front end of it before I decide to pull the trigger and participate in it. And then over the course of the project, I can be confident that I've done my due diligence and I've satisfied myself that my money's on the right horse, the right jockey, and I can let them do their job and step back and stay out of their way over the life of the project for the most part. But really, I put my time and effort on the front part of the evaluation of each opportunity. But yeah, I perhaps there's a lot of others that don't do that, but that's just each individual style, I guess.
Well, then it comes to the actual facility itself, and let's break this into two parts. First of all, there's I guess the physical aspects and component of the facility itself, and then obviously the financials. So let's talk about the physical side of the facility itself in terms of age, construction, maybe functional obsolescence. What are you looking for that excites you, and are there any hard stops in terms of an age of a facility that maybe you would shy away from and cause you not to invest in it?
No, I really don't have any fixed feelings in that area, right? The projects that I've participated in, I'm currently invested in a value add project where it's an existing facility that had existing cash flow associated with it, with expansion opportunities built into it. So it had immediate cash flow associated with it. I've also had the opportunity to participate in ground up development projects as well. So I'm open-minded and exploring and actively participating in both the ground up development as well as the value add. So it's really more a matter of, the market where it resides, as well as the promoter that's making it happen.
Mm-hmm. Well, Pat, one of the things that I appreciate most in you is your ability to look at a set of financials and underwriting and taking a P&L and making sure that you have dotted all your I's and crossed all your T's. So when you receive an offering memorandum and you have the underwriting package and projections on a project, what is your particular approach to underwriting, and what do you do with that analysis once you have it in your hands to satisfy you?
Yeah, when we were talking earlier about the trust but verify, I mean,
Mhm.
I will take the financials that are shared and drop them into my own spreadsheet, and just to run through the math and to satisfy myself that the numbers work. I mean, I've found in the past that, there's often a lot of changes and iterations as these projects come together, right? And sometimes the numbers that make their way onto a PowerPoint aren't always accurate, and it's worth the time just to, and it helps me better understand all the different pieces of the P&L and what's going on in the pro forma by putting them into a spreadsheet and evaluating them from that perspective to get a sense of the projections from the revenue side, the expenses, the expense ratio, what that looks like, and getting deeper into, all of the underlying areas of the financials, right? What's the lease up rate assumptions, and the competitive analysis, what's the supply and demand look like in that market?
So speaking of the financials, then it comes to the returns. There's obviously some certain returns, things that catch your eye as to why you would dig deeper into a project. So, what are some of those the calculations that you're interested in, whether it be IRR over the life of the project, the length of the project? Are you more interested in an equity multiple? Tell me what interests you the most, and perhaps maybe even some parameters or ranges that get you excited before you invest in a project.
Yeah, I mean, probably the IRR is the internal rate of return is the most meaningful KPI for me, but I find that I need to take a holistic view
Hmm.
across the financials and different parameters, considering the type of project that it is to get the full picture, right?
Hmm.
You know, many of the promised KPIs, equity multiples, they all look quite similar. And for me, it's really about peeling back a couple layers of the onion to better understand the underlying assumptions that are baked into
Hmm.
delivering, that equity multiple or the IRR that's associated with it.
Hmm. Yeah, at the end of the day, we as syndicators and the promoters, we're really in the money business. We're putting these returns out there into the marketplace to folks like yourself and stating this is an investment, and these are the returns that we are projecting, and it just happens to be backed by this real estate asset class, by this self-storage facility, this development, this conversion. But we have to be competitive, and so yeah, there isn't a large range or a wide range of returns or variances in IRR and equity multiple, and some of those projections and calculations do go hand in hand. But most of the projects out there are within a few points of each other. It's only when we see that the folks that are 5 to 10 points, above what most of the other projects are out there, we begin to scratch our head and think, well, okay, well, for my own edification, I want to dig into this a little bit further and really realize that perhaps that syndicated promoter is a little newer, and either they're unrealistic in their expectations, or that they know because they're unproven that they're going to have to offer up a little higher return for somebody to truly take a chance on them and their project. In order to raise the capital, they have to have a higher return and give away more of the deal. So kind of an apology of value up front, that we're going to offer you more of the deal and more of the returns, but we may not be able to hit this because we don't have the experience in doing so. So always something that we look at both sides from a passive investor standpoint and just our experience out there, that it isn't always about those numbers, because as you said, anybody can put something on the PowerPoint and in their Excel and manipulate the numbers to make it look good. But, have they, been through an entire project or multiple projects where here are the projections that they've had, that they stated. Here is how the project performed and how close was that at the end in meeting those projections. And that's one of those things that I think you really need to take a hard look at and dealing with promoters. So that being said, Pat, tell me about some of the projects. And I know you've looked at a lot where you've gotten that far and you've vetted the promoter, you've looked at the marketplace, and you've done your calculations and taken a look at the projections to see if they're realistic or not. What are some of the projects or some of the things that stood out on these deals that you didn't invest in? What were some of those red lights that said, I think this is one that I'm going to pass on? Can you draw on some of those right now for our folks?
Sure, and it kind of ties on to the last question you had as well, and you had some great points about the returns offered in some of these projects and how they sit relative to other competitive or similar offerings out there in the space. And when I see something that doesn't smell quite right, or it makes me curious, and I dig a little bit deeper to understand it, and often it'll lead to a conversation with the promoter to understand what their assumptions are, or how that's going to happen over the life of the project. And it tells me a lot about not just their assumptions, but about the style and the nature of the promoter that's behind the project. I mean, is this promoter somebody that's conservative like I am, that's putting a conservative set of numbers together with the intention of under promising and over delivering? Or is it somebody that's been a bit more optimistic than I might have been in putting the pro formas together to really kind of juice up the returns in the offering to attract more investors, right? So I find that probing and asking some questions in those areas help me understand the thought process of the promoter as they're putting the opportunity together. It helps me understand the personality and style of the promoter as well. And I certainly would prefer to align with somebody that's more conservative and gives me confidence that they've got the ability to deliver on what's promised.
Well, and that is big. And we as syndicators and promoters know that that's what investors are looking for. And so there probably isn't a syndicator or promoter out there, unless they're full of bravado and new at this, that will tell you that they're not conservative, because we all say we're very conservative in our numbers. But the proof is in asking those questions, as you just mentioned, and seeing the answer. If you get to the one-on-one with the syndicator and the promoter, because in a webinar or in an offering memorandum, we raise capital based upon our feasibility studies by and large. And so our third-party consultants will vet the deal, and they will put the projections in place. And those are the numbers that we hang our hat on. We may tweak those as we get closer to the end of the project, as we get bids in for the rehab or the construction, but only to actual numbers. There is never, and I say never, a time when we have received some projections back from our consultant in which we have then increased those and shortened the time frame and increased the returns, feeling that we can do better than that. It is always along the lines of either dialing it back, as you mentioned, Pat, and under promising, saying, here's what we received in terms of the numbers from the appraisal and from the feasibility study and the projections from each of those. But you know what? We're going to pad that even further, and we're going to say that it's going to take longer by X number of months, and it's going to cost this much more, and we're basing our projections on that. And so when the investor like yourself, sees that we're baking in a little more of a buffer and truly being more conservative, that is what we feel is going to serve us in the long run. I think it's the beginning syndicators and promoters that feel like, well, my list is small. I really need to put some big returns out here for these folks, or I'm not going to get enough people to bite and fund this deal, and it's going to fall flat on its face. Well, if the first one does, then so be it. They should be thankful that they didn't, versus getting into a project where they then under-delivered, because those folks won't come back and invest with them again either. So I guess that's a lesson on both sides for those folks out there that are looking to promote and be a syndicator. Make sure that you're actually walking the talk if you say that you're approaching these projects from a conservative standpoint. So anything else come to mind, or anything you would add to that, Pat?
No, just that, you're asking if there's any specific red flags or deal killers, but, and I would say no, but not any single thing in isolation. But I do try to take a holistic view across the opportunity and the KPIs, and understand what's going on before I take a decision. And many times, as you know, the IRR that's expected from a given project will be comprised of both cash flow as well as the property sale on the back end of it. and helping me get an understanding of how much of that IRR is coming from the cash flow and how much of it is coming from an ambitious cap rate on the exit of the deal as well, helps me understand uh,
Mm-hmm.
my personal interpretation of that.
Mm-hmm.
And some other areas, just to close out, in that, many of the deals that I choose not to participate in, oftentimes it's more a reflection of me probably than it is of the opportunity. And it's many times it might imply that it's not an individual that I've taken the time to build a relationship
Mm-hmm.
with, or a
Mm-hmm.
market that I'm familiar enough or comfortable enough with to pull the trigger and make an investment.
Yep, very fair. As my pastor puts it, when you're nowhere, whether something is right or not, when it comes to an investment, and it may not be something that you see on paper that is, on your checklist, but you just get a sense or a feeling on some of these.
Yeah.
So, Pat, you've mentioned you have invested in development projects, and so that's delayed gratification, and you get the big pop at the back end, and that is what it causes the catch up in the IRR. And you're also investing in some of our projects that are value add that are producing cash flow immediately. So tell me, do you lean toward one versus another, or do you try to stagger those so that you've got cash flow coming in, but then also looking for perhaps for some bigger returns and some development projects down the pike for wealth building? What does your approach look like when it comes to cash flowing opportunities versus wealth building?
Yeah. I like to see some cash flow and some preferred returns, but it's not a hard rule of mine. And I think everybody needs to figure that out for themselves, where they're at in their age bracket, and when they need their access to the funds or liquidity,
Mm-hmm.
and to make sure that the opportunity aligns with them. I'm still full-time employed with my professional career, right? So I've got a steady paycheck coming in. So I'm not reliant on cash flow from these funds for the immediate future. So both of them can work quite nicely for me, and I've liked investing in both of them to learn more about those two
Mm-hmm.
different opportunities, right? Both the value add as well as the new development.
So that is also one of the benefits that we mention at the end of each and every one of our webinars and our offerings, is that for some folks that this may be their first foray into self-storage period, that it's a great way to dip your toe in, invest a small amount of money, and then come alongside and be a partner in, an owner in a self-storage facility, and then see the monthly reports and the quarterly webinars, at least for us, what we do, and the reporting and the videos of progress and things that we're doing to really learn the business and get an understanding from the inside as an owner, with very little risk, so that they're then stronger when it is time for them to go out and then become an active investor, giving them that credibility, that knowledge and experience, and especially when it comes to raising their own capital and going to a lender, for their first facility, they feel as if now they're in a much better position and viewed in a much better light, being an owner, and now being able to walk the talk a little bit better. Would you say that being a passive investor has helped you quite a bit more now when you then finally embark upon your journey as an active investor?
Absolutely. I mean, it's given me a front row seat to learn how the business runs and operates, and I've learned a lot and continue to learn by participating in these passive opportunities. So it's a fantastic point.
Mm-hmm. Well, Pat, what would you have to say? Any final words of wisdom for those folks that are looking to invest passively in any form of real estate or self-storage? Some of the things that they should keep at top of mind as they begin their journey on the passive side.
Yeah. I would just say to know what you're looking for and be patient, and take the time to do your due diligence, even on the passive opportunities. And knowledge is power. And I believe that the more that we learn and the better that we understand each of the opportunities, the more that we do to de-risk our participation in those opportunities. So again, I've enjoyed the opportunity to learn from you and your organization, as well as the projects that I've participated in, and appreciate you pulling me into this podcast, and all the work that others are doing in this space to help passive investors like me learn and participate in this asset class.
Well, it's been great working with you, Pat, you and Bobby, and I'm thankful that you put your faith and trust in us, not only to learn from our organization, but also to invest with us as well. And don't worry, as I said before, we got some unfinished business, and so we're going to get you into your own here before long. So we'll keep working towards that. But one last item is anything that you're reading right now, any tool or resource or anything that you would like to share with our folks before we wrap up for the day.
Sure. Yeah, a book that I've recently finished reading is that The Hands-Off Investor by Brian Burke. A great book by an individual that spent a lot of time in this industry putting syndications together, but he really writes it from the perspective of the passive investor and what to look at in evaluating the opportunities in this landscape. And while he has a lot of experience in multifamily, many of the principles and concepts that are shared in the book are transportable across many different asset classes. So I found that to be a great resource, The Hands-Off Investor.
Yep, I've read it as well, and I purchased that so that I can get an understanding of what folks like yourself and other passive investors are looking for, so that we are prepared for some of the blind spots or questions that maybe that we haven't thought of, so we can address them before they come up, or discredit one of our investments from somebody because we just didn't know what everybody was looking for. So, yeah, great tool, great resource. Well, with that, Pat, once again, I appreciate your time, appreciate working with you, and appreciate having you as a friend and a partner. So thanks again for your time today.
Likewise. Thank you, Scott.
All right. Take care, Pat. Ladies and gentlemen, thank you for listening as always. Now, we're going to be talking about topics like this that are on target for the times that we find ourselves in. So it is important that you are listening to this podcast every single week, because the guests that I'm going to be bringing on and the topics we will be covering are relevant to what we are all going through right now. And it's just going to get better and better and better in terms of the content that we're going to be discussing, and it's going to be more timely than ever. So please, make sure you subscribe to the show and make sure you're paying attention to these episodes as they are coming out during this period, as I am specifically going out and finding guests who are providing really valuable information you need right now. So thank you so much. We'll see you next week.